Imagine a nation born from debt, a country that started with nothing but unpaid soldiers and broken promises, then built the most powerful financial engine the world has ever seen. This is the story of American finance, a 250-year experiment in money, power, and survival. From revolutionary bonds to trillion-dollar balance sheets, from gold vaults to lines of code, the United States didn't just create wealth, it created a weapon. And like all weapons, it's pointed in every direction at once. Before we dive into centuries of crisis and conquest, understand this: finance isn't just about money, it's about trust. Trust that a promise made today will be kept tomorrow. Trust that paper means something. Trust that when the ground shakes, someone will catch you before you fall. America's financial system wasn't designed by geniuses in a quiet room. It was forged in panic, rebuilt in collapse, and weaponized in war. Every institution you've heard of, the Federal Reserve, the FDIC, the IMF, exists because something broke so badly that millions of people suffered. This isn't a story about boring bankers. It's a story about survival, power, and the question that haunts every generation: who pays when the system fails? Our story begins in 1791. The ink on the Constitution is barely dry, and the United States is drowning in Revolutionary War debt. Alexander Hamilton, the first Treasury Secretary, proposes something radical: a central bank, the first bank of the United States. Think of it as America's first attempt to say we're serious to European creditors. But here's the thing about early America: it was terrified of centralized power. The bank gets chartered for 20 years, then Congress refuses to renew it. Why? Because people feared a financial elite more than they feared chaos. So the charter dies in 1811, and immediately the War of 1812 exposes the consequences. Without a central bank, the government can barely fund its own military. Money becomes worthless in some states, valuable in others. Chaos. 5 years later, they try again. The second bank of the United States opens in 1816. Same idea, same fears. This time it lasts until 1836, when President Andrew Jackson, populist warrior against the banking elite, kills it for good. Jackson believed banks were corrupt, that they served the wealthy at the expense of common people. He may have been right, but his victory created 77 years of financial wilderness. Without a central authority, America's banking system becomes a patchwork of state-chartered banks, private currency, and periodic disasters. Panics sweep through the economy like plagues. 1837, 1857, 1873, 1907. Each time, banks collapse, people lose everything, and the economy crashes. No safety net, no lender of last resort, just raw, unregulated capitalism eating itself. By 1913, after yet another devastating panic, Congress finally admits defeat. They pass the Federal Reserve Act, creating America's third and current central bank. This time, the design is cleverer. Instead of one bank in one city, they create 12 regional Federal Reserve banks spread across the country. It looks decentralized, democratic. It's a compromise between Wall Street and Main Street, between New York power and regional suspicion. The Fed's job is simple in theory: stop banking panics, stabilize the money supply, act as lender of last resort. In practice, it becomes the most powerful unelected institution in American life. For better and worse, the Fed will shape everything that comes next. But here's the dark irony. The Fed exists for 16 years before facing its greatest test. And when that test arrives in 1929, the Federal Reserve fails spectacularly. October 19th, 1929. The stock market doesn't just fall, it collapses. But the real catastrophe isn't the crash, it's what happens next. Banks, over-leveraged and interconnected, begin to fail. Depositors panic, rushing to withdraw their savings. More banks fail. The spiral accelerates. By 1933, nearly 25% of American workers, almost 13 million people, are unemployed. Families lose homes, farms, futures. Bread lines stretch for blocks. Children go hungry in the richest nation on earth. The Federal Reserve, designed precisely to prevent this nightmare, stands paralyzed. Some historians argue the Fed made it worse by tightening money supply when it should have flooded the system with liquidity. Others say the banking structure itself was rotten. Either way, the result is human catastrophe on an unimaginable scale. Enter Franklin Roosevelt, 1933. His New Deal doesn't just provide relief, it rebuilds the entire financial architecture. Glass-Steagall separates commercial banking from investment banking. The logic? Banks that hold ordinary people's deposits shouldn't be gambling with that money in securities markets. Build a wall between savings and speculation. Then comes the Federal Deposit Insurance Corporation, the FDIC. Revolutionary concept. The government guarantees bank deposits up to a certain amount. Your money is safe even if your bank fails. Instantly, bank runs become rare. Confidence returns. It's one of the most successful government programs in American history, and most people don't even know it exists until they see that FDIC sticker at the teller window. The New Deal creates a financial system with guardrails. Boring banking. Safe banking. For 40 years, it works. July 1944. World War II is still raging, but Allied victory looks inevitable. Representatives from 44 nations gather in Bretton Woods, New Hampshire, for a conference that will remake global finance. The question on the table: what comes after the war? America, now the world's creditor and sole nuclear power, has an answer. The dollar becomes the center of the global monetary system. Every other currency pegs its value to the dollar. The dollar pegs to gold at $35 per ounce. Suddenly, the entire world's financial system revolves around American currency. Two new institutions, the International Monetary Fund and the World Bank, are created to manage this new order. It's not just economics, it's geopolitical dominance wrapped in financial architecture. For 27 years, Bretton Woods gives America extraordinary power. Need to fund the Cold War? Print dollars. Everyone needs them. Want to punish an adversary? Cut them off from dollar markets. But empires have costs. By the late 1960s, America is hemorrhaging gold. The Vietnam War is draining resources. Other nations, especially France, start demanding gold in exchange for their dollar reserves. The math doesn't work anymore. August 15, 1971. President Richard Nixon appears on television with a stunning announcement. The United States is suspending gold convertibility. The Bretton Woods system dies overnight. From now on, the dollar floats. Its value is whatever markets say it's worth. Some call this the Nixon shock. Others call it liberation. Without gold constraints, the Federal Reserve can expand money supply at will. Inflation becomes a policy tool, not a gold-imposed ceiling. It's the birth of modern monetary policy and the beginning of endless debates about whether fiat currency is economic miracle or inevitable disaster. The world adapts. The dollar remains dominant not because of gold, but because of America's economy, military, and the sheer momentum of global trade. Oil gets priced in dollars, debt gets issued in dollars. The dollar becomes too big to fail. The 1980s bring a new kind of disaster, one most people have forgotten. Savings and loan institutions, small local banks that held mortgages and deposits, begin collapsing by the hundreds. Deregulation, fraud, risky real estate bets, and rising interest rates create a perfect storm. By the time the dust settles in the early 90s, 747 savings and loans have closed. The Resolution Trust Corporation, created to clean up the mess, spends $124 billion taxpayer dollars. That's real money, not authorized, but actually spent. Families lose savings. Communities lose institutions that had anchored them for generations. The S&L crisis gets overshadowed by later disasters, but it establishes a pattern. When finance fails, taxpayers pay. The profits are private, the losses are public. This bargain, this unspoken deal, becomes the foundation of modern American finance. 1999. After decades of erosion and lobbying, Congress finally repeals the core of Glass-Steagall through the Gramm-Leach-Bliley Act. The wall between commercial and investment banking crumbles. Universal banking returns. Banks can once again hold your mortgage while betting billions in derivatives markets. Supporters argue the separation was outdated, that American banks needed to compete globally. Critics warn of concentrated risk and moral hazard. Both are partly right, but the timing is haunting. 9 years later, the financial system explodes. Here's the nuance historians emphasize. Glass-Steagall had been weakening for years through regulatory interpretation and bank consolidation. The formal repeal was more like acknowledging a wall that had already crumbled, but symbolically, psychologically, it signaled that the New Deal era was over. The guardrails were coming off. September 15, 2008, Lehman Brothers, one of Wall Street's oldest investment banks, declares bankruptcy. The financial world freezes, credit markets seize, overnight lending stops. The global economy teeters on the edge of complete systemic collapse. How did we get here? Subprime mortgages packaged into complex securities sold globally, backed by faulty ratings and mathematical models that assumed housing prices would rise forever. When housing crashed, the entire apparatus collapsed. Banks, insurance companies, investment funds, all interconnected, all over-leveraged, all falling at once. The government response is unprecedented. The Treasury Department creates TARP, the Troubled Asset Relief Program. Congress authorizes $700 billion to buy toxic assets and stabilize banks. $700 billion. The number is so large it becomes abstract, meaningless. But here's what most people miss. The net lifetime cost to taxpayers was far less, about $31 billion. How? Many TARP investments were repaid with interest. Banks recovered. The government even made money on some deals. This doesn't erase the moral outrage. Executives who destroyed wealth kept their bonuses while families lost homes. But it complicates the narrative. The Federal Reserve goes further. It doesn't just lend to banks. It creates emergency facilities to lend to money market funds, commercial paper markets, even foreign central banks. The Fed becomes lender of last resort, not just to banks, but to global finance itself. The balance sheet explodes. This is where the moral hazard debate ignites. If you rescue every failing institution, what incentive do they have to avoid risk? If profits are private, but losses are socialized, isn't that just capitalism for the poor and socialism for the rich? These questions remain unanswered, festering beneath every subsequent crisis. 2010, Congress passes Dodd-Frank, the most comprehensive financial reform since the New Deal. It creates the Consumer Financial Protection Bureau. It requires stress tests for large banks. It attempts to address too big to fail. But does it work? Depends who you ask. Banks complain about regulatory burden. Consumer advocates say it doesn't go far enough. The largest banks are now even larger than they were before the crisis. Concentration has increased, not decreased. Dodd-Frank is a testament to the difficulty of financial reform. The technical complexity, the lobbying power, the fear of unintended consequences all conspire against meaningful change. We add rules without changing structure. March 2020. A novel virus shuts down the global economy. Markets crash, businesses close, unemployment spikes overnight. And once again, the Federal Reserve intervenes. This time, the response makes 2008 look modest. The Fed's balance sheet, essentially the assets it holds, explodes from $4.3 trillion to over $7 trillion in just 3 months. Eventually, it peaks near $9 trillion. $9 trillion. The Fed is buying treasury bonds, mortgage-backed securities, supporting corporate credit markets. It's not just lender of last resort, it's the market itself. Critics call it money printing, inflation time bomb, asset bubble creation. Supporters argue it prevented economic depression, saved millions of jobs, stabilized critical markets. Both are probably right. By mid-2025, the Fed has begun quantitative tightening, slowly selling assets, shrinking the balance sheet back towards 6.6 or 6.7 trillion. But the precedent is set. The Fed's balance sheet is now a central political and economic tool. Expansion to ease crisis, contraction to fight inflation. The line between monetary policy and fiscal policy has blurred almost beyond recognition. Here's the deeper transformation. American finance has evolved from a bank-centric system to a market-based shadow banking labyrinth. Money market funds, repo markets, pension funds, hedge funds, trillions flowing through institutions that aren't banks, don't face bank regulations, but can trigger systemic collapse. The Fed's role expands to match this reality, becoming guarantor not just of banks, but of market liquidity itself. This raises uncomfortable questions. What happens when central banks own so much? What happens when markets assume the Fed will always rescue them? What happens to capitalism when risk has no consequences for those who matter most? So, where does this leave us? America's financial system is simultaneously more sophisticated and fragile than ever. We have more tools, more data, more regulatory agencies. We also have more complexity, more interconnection, more ways for catastrophe to spread at digital speed. The debates that began in 1791 haven't been resolved. They've just evolved. Centralization versus decentralization. Wall Street versus Main Street. Moral hazard versus systemic stability. These aren't technical questions. They're questions about what kind of society we want to be. Some predict the next crisis will come from climate risk. Trillions in stranded fossil fuel assets, coastal real estate underwater, agricultural collapse. Others point to cyber vulnerability, algorithmic trading, or geopolitical fracture. The dollar's dominance is being challenged by digital currencies, Chinese infrastructure financing, and simple exhaustion with American power. But here's what history teaches. The system will break again. It always does. The question isn't whether another crisis comes, but whether we've learned anything from the last ones. Will we rescue the powerful and abandon everyone else? Will we rebuild with genuine guardrails or just add complexity to preserve the status quo? American finance is an ongoing experiment with no control group and no end date. Every generation inherits a system shaped by past crises and shapes it for future ones. The story doesn't end, it just accumulates chapters. From revolutionary debt to trillion-dollar balance sheets, from gold bars to lines of code, this is the story of American finance. A system born in compromise, forged in crisis, and constantly reinventing itself to survive. It's created unimaginable prosperity and devastating inequality. It's freed millions and trapped millions more. The claymation figures we imagine, bankers in suits, families in breadlines, presidents making impossible choices, they're all still here, just wearing different costumes. The game hasn't changed, only the stakes have grown. If this story raised questions you can't shake, good. That's the point. Drop your thoughts in the comments. What surprised you most? What angers you? What do you think comes next? And if you want more stories that pull back the curtain on the systems that shape our world, subscribe. Because this story, it's still being written, and you're living in it.